types of risk. There's lots of types of risk. So when you own real estate, what are some types of risks that you take and deal with? Perfect. That was the first one on my list. Nicely done. Vacancy risk. You know, well, I bought it. I think there's going to be so much income, but what if nobody's in there? I'll give you another one. And this is a property that I almost bought. It was a property in Palm Beach. It was a wood frame house. It was entirely uninsurable. I could not get insurance on it. But I could buy the house for $12,000. And the rent that I would get in the area, if the house lasted more than 3 years, it would pay for itself. I was going to buy the house. I was prepared. I put the offer in and whatever, they sold it to somebody else. But absolutely, it was a risk. If a hurricane came and blew away in a year, I lost money. If it lasted for 5 years, I made money. It's a risk, all right? Understand risk. Now, maybe some of you would be like, yeah, I'm not making that deal. Okay, I never said I was right in the head. I just said it's a risk. Analyze the risk, understand it, understand what it does.
Special assessment service.
Special assessment risk. Absolutely. If you have condos, you always run that risk, right? Here's another one that I did buy. I had a home in Dade County. You're required to get a certificate of use when you foreclose on a home. They have to issue a certificate of use as the foreclosing bank before you can sell the property. Somebody had a property, they knew there were code violations and there were problems with it. So the bank actually said, hey, look, we'll give you this property, we'll sell you this property at a discount, but understand you're not going to be able to get a certificate of use with the property. But it's occupied and generating income. I looked at the income versus the purchase price, it was like a 15% rate of return. I bought it. Absolutely, I finished the foreclosure. I'm going to keep it till forever. I don't care if it doesn't have, it doesn't matter. I'm not going to sell it. And when I do sell it, I'll take it, I'll go rectify it. But you know, it's a different way of looking at business. We talked about it yesterday, liability risk. Recommending 3 vendors versus recommending 1. It's a business risk. It's a risk we think about, right? It's a risk that we deal with in our business. So recognize that it's a risk. There's tax impacts, estate taxes, FIRPTA. I know I keep talking about FIRPTA. One of these days I'll actually tell you what it is, right? Capital gains. You guys like to watch these shows about people that flip homes? I'm going to tell you a little dirty secret. When you flip homes, you get to pay this thing called short-term capital gains.
What? I didn't understand, sorry.
When you flip homes, if you hold a property for less than a year, you get to pay this wonderful thing called short-term capital gains. Anybody know what the short-term capital gains rate is? 30+%. You know what the long-term capital gains rate is? 15, and unless you're in the top tax bracket, it's 20. You want to know why I hold my properties? And I never sell unless I absolutely have to? I don't like Uncle Sam that much. Well, I like Uncle Sam, just.
What about a 1031 exchange?
You can do a 1031 exchange. It keeps your basis. But the knock of the 1031 exchange is it puts a lot of pressure on you to take and close, which means you may have to wind up settling for a deal that you don't like. I mean, I've done 1031 exchanges on my own stuff. I sold a bunch of assets in New York when I came down here, and we did 1031 exchanges on a bunch of them. They're tough. They're tough. The money has to go. You can never touch the money.
Better for land and stuff.
I'm sorry, what?
I think 1031 exchange is better for land.
It can be. It can be. I mean, look, it's a like-kind exchange. A 1031 exchange basically says, hey, look, I'm just swapping this property for this other property over here, and I'm not actually touching any of the money. I'm not getting into the benefits of the money. You can't take any money out. And then you take and you reallocate it to a new asset. The knock is, though, your basis for depreciation stays the same. So let's say you bought $1 million property and you depreciate it down to $600,000 of value on your books. We'll talk about this a little bit later. I'll show you depreciation. I have a good graph for you. All right? You buy this now $2 million piece of property. Your basis of $600,000 moves over there. So instead of being able to depreciate the full $2 million, you only get to depreciate $600,000 of the value, which, yeah, it kind of makes you sad on the inside, like right here. Yeah, no, me too. We'll talk about it. I mean, I'll get to depreciation and it'll be a little bit clearer. I don't know if everybody understands it, so I don't want to take and go too deep down that rabbit hole, but I'll revisit the rabbit hole. Me and the rabbit will have lunch later. Educated response when we get, you got to be prepared for questions. And this is the thing, I'm trying to take you guys' level of what you understand a little bit higher, so that when questions come in, they're all well within your wheelhouse to go smack them out of the park. You can not only answer the question, you can answer the snot out of the question, so they're afraid to ask you the next question, because you got it covered. All right, these are some questions you should think about. We talked about this yesterday. Does a bad day on Wall Street affect real estate? How? What does the housing starts number mean? What is that? Yeah, that's our future competition, right, guys? Okay. What is the median income to home price ratio in your area? What is a reasonable rate of return an investor can expect in a rental property? This is a big one. I mean, just as a basic agent thing, this is something you should be ready to get your hands on. What kind of risk ratios do you use? How much do you take and say for vacancy? You know what, our market right now, normally we'd say 10, but you know, the market's so hot, we can probably say 5. Maybe we want to be a little bit on the safe side and calculate, maybe the market is tending to be a little bit less strong. Maybe we'll calculate 7 in there, you know? But at least be thinking about it. Understand that risk is a cost of doing business, and we have to take and manage the risk for our customer, all right, in our calculations. What is your competition for investors' money? What else is out there? Hey, you know what? The stock market's crushing right now. A lot of people don't want to take their money out of there and put it into real estate. What's our argument? What can we say? We should at least have an opinion on the matter. It's our field. We should at least be able to talk about it. What can people expect for appreciation in real estate? Overall, we're talking macro market, like the United States, 3.5% a year, pretty much since the beginning of time, is long-term what you can expect. Compounding rate of return. Do you calculate into your rate of return when you do your investors, when you do your workup for your investors? This is what I'm going to show you a little bit today.